Welcome to Chapter 8. And in Chapter 8, we're going to take a deeper look at inventory. In the prior chapter, Chapter 7, we looked at how we assign costs in terms of the acquisition and the sales of our inventory and the various methods we can use to do that. In this chapter, we're going to look at situations where, regardless of the method that we chose to assign costs, if the market value differs, either higher or lower from our historical inventory cost, from our book value, how we treat those fluctuations or I guess changes. So we have situations where sometimes, for whatever reason, inventory values differ pretty significantly from a market value versus what we've historically paid for the inventory, regardless of the method we've chosen. If we're working in a technology field, as you know, things are very expensive when they're brand new on the market, and as they become gain wider distribution or newer models come out, the older models become less and less valuable. I mean, if you go and buy an older iPhone version today, you're going to pay significantly less for it than you would have paid the day it came out. Similarly, and more traditionally, costs rise. And so we could have situations in either of those scenarios where our traditional book value that we've used to assign inventory costs is inconsistent with the market value. And so there's a couple of rules we're going to look at, and we'll start first with the lower of cost or market rule. The lower of cost or market rule says that we're going to book our inventory the lower value, whether it's our cost that we've assigned through LIFO, FIFO, the other methods, or whether market value is lower, and that an honest representation of our inventory demands us to, in fact, write down our inventory to market value. And this would be a classic instance of something technologically related where we've purchased inventory at a higher value, but that the cost to replace it has actually gone down as the items have gained wider distribution. Maybe they are more efficient at marketing it, or maybe its popularity is decreasing. So this basically gives us a more conservative approach to valuing our inventory, because if prices are in fact declining and what we have on our book value represents a higher value than what we could replace it for today, that may deceptively show our inventory as being more valuable than it is. So using this lower of cost or market method provides a more realistic representation to our true inventory value. So there are a couple of ways that we can approach the lower of cost or market write-down method, and it depends on which of the 4 inventory methods we chose in assigning book values to our inventory costs. And so if we have used a FIFO, a weighted average, or specific identification method, we're going to use a market value analysis referred to as the net realizable value. If we've used the LIFO or the retail inventory method to arrive at our book value, then the measure of market value will be current replacement cost. So we're going to look at a couple of definitions before we dive into this. And the first is the net realizable value. The net realizable value anticipates a selling price in the ordinary course of business, not a distressed liquidation type price, even though this entire method is premised upon the fact that inventory costs are declining. We're going to assume still an ordinary course of business. We're then going to subtract from that the predictable costs of completing the item, disposing the item, or transporting the item, I guess I could say. Then let's look at what it means to discuss replacement cost. And it's the cost that the company would pay to replace the item. Under GAAP accounting, there is a ceiling and a floor that we are constrained by when we're looking at replacement costs. So we just can't go willy-nilly out into the world and start choosing replacement cost items. So under the replacement cost analysis is this net realizable value. So ordinary course of business sale less some appropriate costs. And that's the top level that we can go to when looking at replacement costs. The bottom level we can go to when we look at replacement costs is this net realizable value minus a normal profit margin. So this net realizable value is kind of your starting point regardless of what your valuation methodology was for your inventory costs, but then you're going to determine whether or not that establishes your ceiling or whether you do further analysis and that determines your floor, and then you look at whether the replacement cost falls within that. So here's our example. We've got the Sahara company. They use the LIFO method, and so they've got their selling price here, their packing, transportation. So first we're going to look at what the net realizable value is, and that's $140,000. That's our selling price less our normal costs that would be associated with that. And that gets us to our ceiling. To get to our floor, we subtract from that our normal profit margin, which would be $40. So now, if our replacement cost is either above $140, so if our replacement cost is above $140, we are capped at this ceiling. On the other hand, if our replacement cost is below $100, we are similarly capped on the bottom end at this floor. So we would whether we were above or below, we would rely on these upper or lower end caps. If we're right in the middle, then we use our replacement cost that is our true replacement cost in the middle. It's only when the replacement costs exceed one way or the other, the ceiling or the floor, that we're limited on either end. Now we're going to basically summarize and walk step by step through this process. So the first thing we need to do is we need to make a decision on how we're going to apply this. Are we going to do it across our entire inventory as a whole? Are we going to look at it on an item by item basis or on categories of inventory? And remember, the idea is to give an honest representation or a fair representation of our inventory. If we look at it as our inventory as a whole, there will be some parts of our inventory that may have gone up and some parts that may have gone down, and they may compensate for one another. And so where we have a really undervalued portion of our inventory, it might be masked by parts of our inventory that have increasing values. So that might be a pitfall of trying to do this across our entire inventory and suggest that maybe we need to look at it, our inventory in segments in a way that makes sense to our company. So once we've made that decision, then we have to determine what our market value is. And what our market value what determines our market value depends on what our cost approach to inventory is. So if it is the FIFO, the specific identification, or the weighted average, our market value is going to be the net realizable value. If it's the LIFO or the retail inventory, we're going to use replacement costs, but we're then going to have to determine the ceiling and the floor for that. The ceiling being the net realizable costs, the floor being the net realizable minus the profit margin. So in any event, you're still going to begin with a calculation of your net realizable value, but with LIFO or retail inventory, you're going to have to then calculate the ceiling and the floor, gather your replacement cost information, and then see where that lands within your ceiling or your floor. And so, yeah, so we compare our market value to our cost. We then make a determination as to whether or not our cost, what's lower, cost or market. And then we report the results in the financial statement by using the lower of the cost or the market value in our balance sheet. And so if there's a loss, there are two different ways that we're going to reflect, potentially, that we could choose to reflect that loss in our financial statement. And this is just a flow chart of how we make those, of the analysis that I just went through in those 4 steps. So first we decide how we're going to look at our inventory, how we're going to make this analysis. Do we use individual items? Do we do it major categories or the whole inventory? Once we've made that decision, we have to determine the market value. If we're using FIFO, average specific identification, we're going to the net realizable value. If we're using LIFO or retail inventory, we're going to look at replacement costs, but still calculate the net realizable value as our ceiling, and then the net realizable value minus the normal profit margin as our floor. And if our replacement costs are in the middle, we use our replacement costs. If they are above, we use the ceiling, and if our replacement costs are below, we use the floor as our market value. And then we, regardless of what method we've used to determine this market value, we then compare it to our book value, our cost of inventory. And whichever is lower, that's what gets reported on the balance sheet. And if it results in a loss, we need to carry that over to the income statement. And this is just an example of the rule as it applies to on a product by product basis. And sort of a longer version, and you can pause these if you want to look at it in words, since I've already kind of gone through it a couple of different ways. And so again, this discusses whether we're going to use major units of inventory, individual items, or the entire inventory, and the potential hazards of having it applied on the total inventory and having areas compensate for one another. From a conceptual standpoint, the reason that the purpose of the constraints of the ceiling or the floor when we're looking at market value from the standpoint of the LIFO or the retail method is that if we don't, we could potentially have wild over or under valuations of our inventory. And so this is to prevent those sort of excessive or understated valuations. And so this is a kind of a comparison of using the sort of what our costs come out to versus our market on an individual, a category, or a total item basis. And so you can see that by doing it on an individual inventory item basis, it results in a loss recognition or the greatest loss recognition. The categories also gives us a loss recognition, but you can see where if we did it on the total inventory, we've got areas of our inventory that are fluctuating enough to compensate for one another, so it doesn't show that we have any loss, which certainly pleads the case for doing this on an individual item basis, although could certainly be a laborious task doing that, and so again, the cost of doing it has to certainly make sense as well. So this lower of cost or market method results in the market method being lower, we then need to write down our inventory from the cost that's on our books to recognize now the market value. And there's two ways to do that. There's the direct method and there's the allowance method. If we use the direct method, we're going to record the loss directly to the inventory account. And if we're going to use the allowance method, we're going to have a separate allowance account that's going to be a contra account. And your slide says here, the allowance method is preferable because it very clearly sets out, because it's a contra account and therefore its own line item, how much we've written down our inventory. So now we're going to look at an example of these two methods and what this actually looks like. So we've got the Gasparilla Golf Company who uses the perpetual inventory method, and they're going to apply it on an item-by-item basis as opposed to their entire inventory. We'll start with the direct method. In both our scenarios, we're writing down our inventory by $3,500. And so here we see a $3,500 debit to cost of goods sold, and then we see credits to lower the inventory valuation. Now, remember, this cost of goods sold will eventually appear over on our income statement as well, and will reduce our earnings by the $3,500. So it will have an impact on both our balance sheet and our income statement. And now we look at the allowance method. And the allowance method is going to show up as a contra account and will be very clearly set forth on our statements to show how much of a write-down we've taken on our inventory over this particular accounting period, as opposed to just sort of blending it into the existing inventory and cost of goods sold figures. Similarly, when we've had other items, when we report bad debts, for example, setting those off separately makes it very clear to the extent that we've written things off during an accounting period. So both of these methods are going to impact both our balance sheet and our income statement. It's just the method that they will appear. So on our direct method, we're going to have it recorded to set off our inventory, which will affect our balance sheet, and our cost of goods sold, which will reflect in our income statement. Whereas under the allowance method, we're going to have a contra account on our balance sheet and a separate line item on our income statement. So both statements will be affected regardless of the method. The allowance method just makes it very clear as its own separate line item how we treated those things. And here's an example of notes in a financial statement that you would see that would discuss how that was done. And I'm going to just skip over this example. You can pause the video if you want to read this. So conceptually, there are certainly pros and cons to using this method. The pros are that when inventory has reduced itself below what its carrying cost is on our books, we're going to reflect that as a faithful estimate of our inventory valuation costs. The criticisms, or one of the criticisms, is that when this only looks at the lower of the cost or market, not the higher of cost or market. So that when we've adopted this approach, we're not making the opposite entry when market costs are higher. And while it's an obvious inconsistency, this is a more conservative approach. And so if we're looking toward being conservative, this approach would do that for us. Now, we will skip on to, or go on to the next video to look at valuing inventory above cost.